right, happy Veterans Day to all of our veterans that are out there in our Market Scholars community, and for that matter, for all the veterans that are outside of our Market Scholars community. And those who watch these YouTube videos day in and day out, thank you very much for your service. I come from a household of veterans in my house, including my father and his father before him. So we appreciate your service and know what a sacrifice that is. I personally know what a sacrifice that is, seeing it in my household. Obviously, I haven't been in the military myself, but I've seen it in my household, and I appreciate it, and thank you. We also have our Black Friday sale going on for the whole month of November. So you'll see that if you see my tweet, my pinned tweet at the top of my account, in the market insert, reply to our Market Outlook tweet there. You can see the details on that Black Friday sale. The market was quiet today, but not everything was quiet. There was, considering that the bond market was closed because of the holiday, even the bond market wasn't quiet when you look at the ETFs that track. So we'll take a look at that. Take a look at the breadth today. Very big move in the small cap index relative to the large caps. Way bigger than what we saw last week. So we'll see, is that exhaustion? Is that breakout? So we'll talk about, is that generally positive for stocks when that's that big of a move? So we'll take a look at that. What's leading the markets higher today? We'll take a look. In fact, our trade idea is actually from one of those sectors that's in that area of the market that's outside of tech, big mega cap tech. That had been underperforming significantly, that may be turning higher. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, November the 11th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. This is the end of the November expiration week, so we'll be taking a look at some of those trades here. We also put on today's trade already before the market closed, so check that out. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Scroll down to today's Market Outlook, click on that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator like we generally do. Again, you can see since the election, we've been up every single day, including today, barely, but we're up today, 0.1%. You can see the ranges have progressively gotten smaller and smaller, 70 points, but not including the gap on Wednesday, and then 36 points, 35 points, and then now 30 points. The intermediate line has crossed back above market sentiment, back into the upper reversal zone. So that's a good sign. Now we don't have to worry about the near-term crosses because it's in the reversal zone. So that's good. The momentum line is oversold. So by definition, we have an oversold intermediate confirmation signal, right? A bullish intermediate confirmation signal that you would expect the momentum line to bounce out of it. The issue is here that your near-term line is still in the upper reversal zone. So it's generally not, when your momentum line drops because of smaller ranges and not because of declines, then you're not going to typically get a bounce out of the reversal zone until the near-term line declines too. Right, so it doesn't have to decline all the way to oversold levels either. You can see eventually it just got, and we didn't go down very much either during that decline, but it was enough decline that we could finally bounce. The momentum line could finally bounce, and we broke out there and we continued higher. So that's kind of the pattern we're seeing here. Again, oversold levels, but you have such a strong near-term line still that I don't expect a bounce, because there's nothing to bounce off of yet, right? You got to get that near-term line at least below the chart's midpoint, even if not in the lower half, into bearish territory, below the 40th percentile. And like I said, good market sentiment line to start with. It's back to going up in the upper reversal zone. Your NASDAQ 100 is a big fuel for that. You can see, even though it was down today a little bit, it's got the same intermediate confirmation signal, but again, and your market sentiment line's rising. It's not in the reversal zone, but it's still rising. So technically this would be a bullish pattern, a buy the dip signal, but there's no dip to buy. So we have to wait for the near-term line to get at least below 50, if not better below 40, before we have our dip to buy. Your Dow Jones did not. It also went up even more today, 0.7%. Its intermediate line has crossed above the 80th percentile, just like the S&P. Crossed the market sentiment, just like the S&P. And market sentiment still above the 80th percentile and rising, just like the S&P. So that's really good. Your near-term line obviously is still above the 80th percentile. So the momentum line did come out. Again, you're kind of this would be a weaker intermediate confirmation signal because your intermediate line is not above 80 yet when we get Friday. It is today, and now it's not oversold. But again, don't expect a big jump in the momentum line until you have more of a dip on the near-term line. Most likely this week we'll get a dip on the near-term line. That's not a big take. It's not a hot take. It is something that most likely will happen. It doesn't mean the markets are going to tank or fall. Like the stocks don't go up every day when they go up. They will have a day or two and go down. When they go down, you'll have the TV types talking about, is it all over? Are we going to roll over? No, it's just you inhale. Every time you exhale, you're not dying, even though you're not breathing in. You're breathing out. Doesn't mean you're dead or dying. You're just exhaling, and that's what the market does. So we'll be talking about the death of the markets when we do get those declines. Whether it's tomorrow or Wednesday or Thursday or whatever, but it will simply be nothing more than an exhale. The Russell 2000, the intermediate line is up above the 80th percentile, above the 90th percentile. Your market sentiment's rising, just like the Dow, but not above the 80th percentile yet. Your momentum line, also like the Dow, jumped out of the reversal zone because we moved up higher today, 1.5% higher on the Russell 2000. But again, your near-term line is still very bullish, so don't expect a big jump in the momentum line until we have more of a dip to buy. So again, a really, really good move. In fact, going back the last 5 days in the Russell 2000, if I were to go to rate of change, we looked at this in our last video. But if I were to do a 5-day rate of change for the Russell, so this would include even before the election, again, this was a big, strong move of almost 12% in 5 days, but we are now up 9.73%, which, again, outside of what we just saw earlier this year, that's the biggest move we've seen since coming off the COVID lows in a 5-day period, right? And even remember we had the big, you could argue the 2020 election was a bigger deal for the Russell 2000 because it reopened, right? The markets reopened. Even that, coming off of that election news, we were only up 8.7%. But again, you can see the type of move that we've gotten here to get to where we're at. I mean, that was coming off of a 5-day drop of 6%. Obviously, we're coming off a 5-day drop right now of about 1% before this big takeoff that we had. Again, and that was the first day. The first day of that 5 days is actually before the election. So really, really good run. But again, you can see that we don't typically go up too much higher from this. We got up higher than this because we were so much lower than that before. So don't expect we'll be going up to 15% here on a 5-day period. We're really going to start to drop off. Not so much tomorrow because we have to replace a pretty decent game, but not extreme. But when we take this off the table, then it's really going to drop, even if we're up the next 2 days. All right, let's take a look at the weekly chart. And you can see the nice, good bullish candle after transition candle last week. Have a good, strong bullish candle this week. We already have a new high. Obviously, the higher Hakinyashi close. So very, very strong candle. Not the biggest bullish candle we've seen, but pretty decently bullish. We're back above the 90th percentile in the PPO. So again, we're not coming off of a low point here. But we're maintaining what was a strong trend already. We're continuing to maintain that very strong trend as it is. Obviously, that's showing up in 3 green arrows across the board with pretty decent momentum. If you look back, if I were to zoom out, again, we're not coming off of a bearish move like we were over here. So you had a much bigger histogram, and And for that matter, you can see the volume down there, the first time below average in the last few days. But you can see the histogram is not as high as it was when we came off that low. The MACD is not as high as it was. So this is probably about the extent of where the MACD and the histogram are going to get. So we'll take that for what it's worth. You can see it's a little bit higher in IWM compared to when we came off of like that same low point for IWM. We actually didn't go up as much, and this is a more of an extreme move. And again, it's like, oh, we hate to have that be, again, we're not coming off of a low point here. We never did get below the 50-day. The MACD was barely negative, so we're not coming off of an intermediate decline. So we hate for this to be an exhaustion of what was already an intermediate run. Again, we're going to get a near-term decline. It's not going to be the end of the world, and it's not going to go up at this pace. Momentum is going to pull back. So that's what happens even over here. The momentum pulled back, and we didn't necessarily go straight down. We still stayed up for a while before we had a pullback. So we get a pullback like this over the next few days to the 8-day moving average because we're so far above it. You can see, we're more above it now than we were then. When you look at the simple moving average relative to the today's move, we were a little bit more above it on that day. But we're pretty far above it. You're going to come back down to it, right? This blue line is going to come to zero, which means we're going to come down to the 8-day, and the world didn't end, and it won't end this week either when that happens. When we look at some of these other oscillators, you can see that we are still well above 30 on the negative, which means the ADX is going to get up here on the positive. The ADX is going to get up here. That's lagging. The negative did get below 20, so a very strong move. Of course, remember, IWM is a bigger move. We were above 40, and the ADX was below 10 when that started, and you're way below 20 on the negative indicator. So big move higher. That ADX is really going to take off and go parabolic here pretty soon, which will be a reflection of just how strong this 5-day run has been. RSI, still pretty darn bullish there. On the Russell 2000, it's extremely bullish. Remember, it got above 300. Just like it did over here, and it got above 70, which like it did over here. So very extreme on the RSI for the Russell 2000. Looking at the Ichimoku cloud for the S&P, we have a weak trend developing. Remember, it's kind of hard to go from mature back to mature without a bearish move in between. So it's going to be weak, and that's okay. And we can grind away a weak trend. That's not the case on the Russell. We have busted up to a mature trend just out of nowhere. Kind of like we did here. But again, that's the kind of trend that doesn't last. Like when we go from nowhere to a mature trend, it doesn't last. When we go from weak to intermediate strength to mature, it lasts a lot longer and ultimately stays bullish. So that's the concern again, that it's come out of nowhere and we're straight to mature without a nice good growth and momentum to get to that point. Again, like you would see right now in the S&P, the issue is most likely we're not going to get to a mature on the S&P because we didn't, we came off of a mature trend and did not get a bearish trend to reset like we did over here, to reset so we can start a new one. Right? We didn't get that here. In fact, we're still way up above the cloud. The rate of change is very strongly positive. Then you look at your Bollinger Bands and the Keltner channels. Remember, we have been way up above the band. We are now back below the band, barely, but we're back below the band on the S&P. That bandwidth is rising, pretty strong level there. We're still above the Keltner channel. The momentum is still positive. If you look at IWM, we were so far above the band, above the 130% mark. We are now back almost inside the bandwidth, but still easily above the Keltner channel with some pretty, with the spike in momentum that's not done spiking. So again, it's as we talked about before, when you get above 130, it's hard to maintain a bullish trend because it's like we just pulled forward whatever bullish trend we might have had. Like if this would have trended from here up to here by the end of the year, that would have been a really good bullish move, obviously. 9%, we just saw what we saw in the rate of change, how big that move was. That's a good annual return, much less, a good couple month return as we would have built into a nice, strong, mature trend. But we pulled all that forward into the last 5 days. So now the question is, how much more do we have left to pull, to go if we pulled it all forward? That's the problem with what we're seeing here. You see it on the intraday chart. If you look at the intraday chart, obviously we had a higher high today. Sorry about that. Let's see, try to get this back up again here. All right. That was a pain. Sorry about that. So obviously we did get a higher high. We did get a higher low, but we did not close above the high. We did not close above last week's high, which would have been Friday's high. Big range. The range did extend back above 5%. It's not a huge move, but it did extend with the new bullish moon indicator, the one touch on the negative. So we have a long ways to go before we have to worry about any kind of bearish move, right? But you can see again, there's not a whole lot of support holding it up. So that's your near-term decline. That's going to be your near-term decline on the Russell 2000 as well. All right, the gap, today's gap, it's a common gap. You know, and then again, there's not a whole lot there. It's a big vacuum here. So that's your near-term decline. Again, that doesn't necessarily mean that we're going to go bearish. And your when you look at it from this perspective, the stochastics is not going to drop into bearish levels here. Most likely will stay in bullish territory when it drops, and that's okay, right? So that's what I expect is coming this week, and I expect nothing really more than that to come this week. Just a pullback down, maybe out of 80, maybe from below 80, but most likely not even that, right? Most likely it's going to stay above the average and then turn, kind of like we see here, right? Kind of like we see in all these other instances, and we just turn right back up, right? And that's, you know, the fill in gaps, get back, you know, start filling in some support in these areas, and nothing more, right? And just kind of fill in some volume now in that spot. That's the purpose, that's the point, and that's the most likely scenario. And you can see the market is heading in that direction because of the range and the volumes continue to decline. 36 million on the volume, 3 points on the range. So when you look at those numbers in context here, we're back below the 1% mark. The volume's really low as it is already, the average is. And then the volatility is back to being really low, like flirting with 15, flirting with 90% relative to VIX 3M, flirting with 90 on the VVIX, and then the actual VIX itself flirting with its 200-day average, that 200-day average of its own value. As you can see, eventually it'll come up here. There you go. So flirting with its 200, it's a little bit below it. So getting below the 200, getting below 90 in the VVIX, getting below 90% on the relative to the VIX 3M, getting below 15, those are all levels that would suggest, okay, we got a new trend going. We didn't have a pullback to start one, but they're all at levels that would start one. So you know how long that will last because we didn't get a low point to start it, to reset before, that remains to be seen. But at least you know, even if it just grinds higher towards the end of the year without a pullback, I think we'll all take that right now. All right, now let's take a look at what's driving this price action. You can see, look at the 3-month returns on all these U.S. equities, especially relative to international. You can see international is actually down since the election. Emerging markets 5%, 2% on developed markets. So these doubling the developed markets returns. But U.S. equities are more than doubling emerging markets returns, in some cases tripling, more than tripling in the case of IWM. Really significant move here lately, in the last couple of days especially, on IWM relative to its large cap peers. You can see that especially here today because things are so quiet on this holiday. Today here, for the most part, very small. I mean, look how tight that range was in the S&P, but not so quiet in other assets, right? The dollar was strongly bullish today. That is a big move in the dollar when you're up 0.5%, more than 0.5%. Small cap stocks taken off dramatically. That strong dollar put a lot of pressure on commodities and gold, and you can see yields were up. You know, not dramatically, but they were up pretty significantly here today. If you take a look at let's go take a look at the 10-year yield here on the chart. Give it a second to load up. Actually, you know what? Let's actually go. So there's the market forecast, and you can see how strong it is. Let's go to the 3 green arrow chart for the 10-year yield. And again, you can see, you know, it's off today because the bond market's closed today. This is the ETF. Remember that is not trading the bond market. It's not trading necessarily in the bond market. but it's trading these long-term bonds, right? So this ETF can be traded. It's traded in the stock market. And so you don't necessarily see that here because the bond market's closed on the holiday, but you would expect a higher jump in yields based off of what you see on TLT. And for that matter, really the one that matters more for this one is IEF. And IEF you can see is down today, which means is down. In fact, it's down more than it went up on Friday. So it's actually down below where it closed on Thursday. So that would suggest that the 10-year yield is back up above where it closed on Thursday. So 4.434. So you'd expect it to be up there, and that's not surprising considering where we're seeing the dollar index. That's those two, yields and the dollar, typically go hand in hand. And you can see the big continued jump. The MACD is back above its moving average. Stochastics is crossed above its moving average. Again, this will be a divergence. We've already peaked in the histogram at a really high level, relatively speaking. We've already peaked on the MACD at a really high level. So when you've had that big resurgence here from bearish levels, when you cross above zero, you typically cross with the biggest histogram of the move and the biggest MACD of the move. So we're back to having a positive histogram. We do not expect it'll be bigger than that, or even actually approach that. The MACD is back above its moving average. You do not expect it to get to a higher level, right? It's the biggest move is when you go from being bearish to bullish. Now you don't need there's the escape velocity is not as necessary when you've already come off the earth, right? When you've already kind of broke that gravity. So now it's just a matter of how much more we kind of grind higher towards some of these highs above all these, including the 200-day moving average. So a very strong move. And like I said, it put a lot of pressure today on commodities. When you look at commodities, a big drop lower below the 50-day move, already below the 200, but back below was below the 17-day, yes, on Friday, back below the 50 today, right on that point of control. So there's some very strong support here. And if you look at crude oil, which is the biggest component in this basket, a big drop lower on crude oil back out of the value area towards the lower end. Again, a lot of that is dollar positioning. I also put a lot of pressure on gold, which has been so bullish. Look at that first break below the 50-day moving average for gold, as that MACD and stochastics are at levels we haven't seen for a while. Right, you had to go all the way back over here, and so I don't expect a big drop because it's kind of rare when there's such a sizable gap between the 50 and 200-day moving averages to drop all the way down. So it's not as big as it was over here, but it's pretty darn close. So it's probably going to come down into like maybe this range at the most, to 233 on any kind of intermediate, because gold is on an intermediate decline right now. The dollar continues to be on a bullish intermediate move, as you can see, dark green shading and a green line, and market sentiment's rising. Gold is now, we had that bull tag, and now we have dark pink shading and a red line. You're at the 0%. This is the lowest. We've been below the 30-day moving average all year. And the intermediate line is that close to getting into bearish territory. So it is in its own intermediate decline now. Again, similar to what we saw over here, where it's mostly flat during that intermediate decline. That's probably the type of pattern we're going to get again. Again, simply because we are the gap between the 50 and the 200 days, especially when you look at it from like this perspective here, is so wide. So don't put a whole lot of, don't put too much into that. There is a bigger candle. This is a bigger candle than what we saw earlier this year. So in fact, it's one of your bigger candles that we've seen for a while. So there is that can weigh on, again, what is a very high long-term PPO that is rolling over. It's still above the 90th percentile there. The breadth was really good today, and that typically happens when you have a weakness in the the NASDAQ relative to the Qs, right? So you can see a drop on Friday and then another drop here today, well below the 200-day moving average. You can see, in fact, the correlation now is crossed back below 0%. Again, it's not typical for this correlation to be negative. So, but it doesn't mean it can't be, right? It's typically not going to be very strongly negative, nor will it be negative for very long. So keep that in mind. Like it is benefiting right now from the Russell outperforming the Qs and stocks still being bullish. As a result, that's not the normal pattern, and we'll see how that persists because a lot of these indicators are obviously pretty bearish here. So this isn't just a little one-day thing. We're getting some pretty clear changes. Now, granted here, if you look at a little bit of a change here on this calendar. If you take a look at zoom in a little bit, on the daily chart for the relative rotation graph, it's still, XLY, XLC have the highest momentum and the highest relative strengths. Technology is kind of not moving in the right direction there. That's on the daily, but if you look at the weekly versions, you can see the safety trade still moving down to the left, technology, discretionary moving up to the right, and communication services. So that's the move, right? That's the strong move that we like to see. XLK is still, it's down today. Whoops, sorry about that. That was pretty loud. XLK is still well above its moving average there, well above its moving average, even if it's down the last couple of days. Still above the ratio relative to the S&P is still above its 50-day moving average. As you can see, the rotation is not quite positive there. And again, you're seeing that reflected here with the Qs relative. Now, again, if you look at XLK relative to SPY, at least we're still above the 50. We're still around these moving averages. And again, we would like to see a breakout above that 200, a breakout above this 0.4 level, above 200-day moving average. Then we're going to feel really good about this continued post-election move. Otherwise, this post-election move, as we talked about earlier, is kind of just showing signs of, that's been a good move. It's not going to go up every single day, obviously, as we all know. It's not going to go up every single day. And without the leadership of which remember, since the election, if you go back to this chart, and we'll go back to the sector comparison chart here, and go back to the election, or since the election, so starting on, let's see, November, starting on Wednesday, you can see financials and industrials and energy have held up pretty well. Initially, it was financials and energy and industrials, and then technology and discretionary has really taken the baton and led the way higher here, thanks to Tesla and Amazon's been doing well. There's technology and communication services kind of matching the market. Again, your other kind of cyclical areas, materials not doing very well with the strength in the dollar, and then your safety trades lagging. That's not surprising. But remember that relationship of energy, for an example, relative to the S&P 500 is not typically positively correlated. It's been improving, but look at the breakout we're getting. And so again, this is not a correlation that I would bank on a long-term basis. Long-term, it's generally negative. It's been briefly positive here. And so if these sectors, and you can see the other ones were financials and the S&P, like the financials, can be positively correlated briefly, but not very strong. It'll probably a little bit more so than energy. And then finally, industrials, again, is generally speaking negatively correlated. Has a strong positive correlation right now, and we'll see again that didn't last very long over here. And then that ultimately led to some significant weakness in industrials. And, fingers crossed that we don't get that kind of pattern again. Because, again, in May and June and July, when you look at, the S&P 500 in May and June and July. Give it a second here. So May and June and July, we're getting, these convergence periods, and you're getting some volatility at the end of the month. And, again, that's not what we want to see too much. I don't mind industrials outperforming the S&P. The issue is going to be when industrials outperforms XLK, right? So that's the issue, and that's when it outperforms XLK, that's not necessarily the best sign for the markets. You generally see XLK leading the way higher over some of these other areas, cyclical areas. Simply because, again, right now it's simply because the three biggest companies in the S&P are all in that sector right now. And so it's simply by fact of a market-weighted index. When the S&P market-weighted index goes up higher, it's going to generally be led higher by the generals rather than the infantrymen, so to speak. All right. Let's take a look at the breadth today. So I mentioned the breadth with the Russell 2000. The McClellan oscillator is positive. It's not very strongly positive, but we kind of expected that. When you look at the number of stocks above their 50-day moving average, we're still above 300, and we're barely above the moving average. So that's again, a small positive sign from a breadth standpoint. Same thing with the 200, but actually not above the 200-day moving average or 20-day average anymore. But we are still easily above like 350, 300. So we're still fine there. As a result, you can see, part of that is like the number of new lows still is above its average, and that average is rising. Like that's not necessarily great. That generally leads into weakness eventually when you start to see that kind of pattern, especially when you have such a significant move. It's not going to be 600 today, but it is going to be a high. It's going to be over 400. Remember, anything over, it's very rare. The line's at 400. It's very rare to get above 400, and we've had that for the last we've had that quite a while in the last week, a few times, right? We were above 400 on November the 6th. We had that many new highs, and then on November the 11th here today, here on the 8th, we were at 614. Let's see here. On the 8th, we're at 309, sorry. And then on the 7th, we were at 276. And then again on the Wednesday post-election at 474. So, I mean, again, we're not going to be at 614. We're going to be at like 423. But again, that's an extreme, right? That's an extreme level, especially when you consider that like the gamma exposure is at its highest level that we've seen in years, like going back all the way. So this is the gamma exposure here. That level that we hit last week is the highest level that we hit since back in 2021, right before we peaked. Remember, we were in the Robinhood craze, coming out of the shutdown, and everybody was trading options and buying options on Robinhood, and I mean, we had such big volumes and calls throughout that year. It helped really fuel a bullish market. If you go back before that, another time we had this was right before COVID. We had a huge amount of gamma exposure. Outside of those periods, this is one of the highest. I look back, and you can see this is one of the highest that we've seen, and it is the highest since 2021. So a lot of people piling in. That's what this is saying. A lot of retail investors are all piling in on the bullish side, like right now, all together. And you can, again, we see that somewhat in this idea of the number of stocks getting new highs. That's an exhaustion type event. So we'll ride this gravy train while we can, aware of just how exhaustive this type of rally has been. All right, that takes us to our trade idea of the day. Let's take a look at Halliburton. We're back in that energy complex. We've had a recent trade. Now, we've already done this trade before the market closed in our Market Outlook Live. But we looked at Occidental previously when it was trying to rebound. Occidental's actually bound. We closed that trade out in the previous Market Outlook Live video. It's rebounding, which is actually fine today. But I actually like this chart on Halliburton. Dark green shading and a green line, intermediate line already above market sentiment, crossing into the upper half of the chart. The near-term line crossing out of bearish territory, up above the intermediate line, so that's a good sign. The momentum line is above the near-term line, also a good sign. Would be better if the momentum line was in the upper reversal zone. That's okay. I like the dark green shading, the green line. It's been a while since we've had that. If you take a look at the weekly chart, it's been so bad. We've been in this death cross for so long. But your long-term PPO, which is at very, very low levels, and relative to the last 3 years at least, if you go back 5 years, it's not so bad because of the energy. But aside from that, this is about as low as it's gotten. The gap, about as big as it's gotten. The gap between the 10 and 40-week exponential moving averages to the downside. But it's rolling up, as you can see. The PPO is rolling up. We have a bullish candle. It's not above last week's high. But at least it's it's a higher close, and we'll see. It's not a higher high yet, but it's a higher close. We have a pretty decent sized candle. The average is about to turn, or has turned positive. We have a green arrow, which means we've crossed above. Even the Heikin-Yashi close has crossed above the 10-week exponential. So that's a very good sign for the stock. Obviously, you're going to have 3 green arrows on the stock. Not surprising. Kind of a big jump pre-earnings, pull back on the earnings, and then the bounce. Still has the green line, so it's a pretty decent size MACD histogram. You can see like I said, 3 green arrows and the green line, which means the moving average is heading up. We have the MACD is pretty strongly positive and still moving higher. Stochastics is also moving into bullish territory as we move into the gap between the 50 and 200-day moving averages. Your point of control is up right to that 200 days. So we have a good opportunity to kind of fill in that gap there up to the upside. If we go down, and that's right around $34 a share as of right now. If you go down to some of these other oscillators, you can see that we have a positive crossover. We're not quite below 20 yet on the negative indicator, so we kind of need that to really solidify the trend, but at least it's pointed lower and the positive indicator is above it and above 25. So you have the green shading there because the ADX is above 20 and we have the positive crossover is already above 20. The RSI and the CCI, we got really good bullish move last week on Wednesday. And it's back up. It's still at bullish levels today. So that's a good sign. The Ichimoku cloud, looking at that, we're into the cloud now. It's the first time since back over here that we've been into this bearish cloud. The cloud itself is about to cross over. We had a weak bearish trend, and it's now back to being gone. It's below the thresholds, -1, or actually above the thresholds, -1 above that one, and then back below 50, which those are the thresholds for at least a weak trend. We're above the blue line easily, like I said, into the cloud. The rate of change is still positive, but you can see how close we are, maybe a week from it, or excuse me, negative. We're a week from it turning positive. And then if you look at the Bollinger Bands and the Keltner channels, the bands are pretty wide still. It's been narrowing, but it's still relatively wide, so it's hard to get outside when they're that wide at the upper band and the upper Keltner channel, and that's the case. We didn't get there, but we got into the upper quartile, and you can see the momentum has shifted from being pretty strongly bearish to being bullish now without the red dots. So like I said, when the bands are already outside the Keltner channels and we're getting that change in momentum, it's hard to get the cross. We actually did get that above the Keltner channel last Wednesday, but a nice little rebound here into the upper, at least in the upper quartile. So I like the setup for a long vertical. So we're going to come to that 30 delta. Like I said, we already put this trade on in the Market Outlook Live. Here we're going to sell that 32 strike. Remember that 200-day moving average is at 34. So we'll sell that 32 strike, buy the 30 for some protection, keep our costs down roughly around $500, getting a little bit more than a 1.5 to 1 reward to risk ratio. I like that setup. And like I said, a lot of flexibility for timing in case it doesn't work out immediately. So let's go ahead and throw that on. That's our trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.